Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Costco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Costco operates a chain of membership-only big box retail stores. It sells everything at discounted prices. It sells wine, fresh produce. Some stores have a gas station at Costco. Pretty much anything you could find in a traditional supermarket, you could find in Costco, but for cheaper. It is the fifth largest retailer in the world. It has 823 warehouses around the world, 571 in the US, 105 in Canada, 39 in Mexico, 30 in Japan, 29 in the UK, 16 in Korea, 14 in Taiwan, 13 in Australia, 3 in Spain, and 1 each in Iceland, France, and China. 113 million people hold a Costco card. The renewal rate is almost 92%. The first Price Club opened in 1976. The first Costco opened up in 1983. In 1993, Costco and Price Club merged. Before that merger, Price Club declined an offer from Walmart to merge Price Club with their warehouse store chain, Sam's Club. In 1997, all remaining Price Club locations were rebranded as Costco. The company is headquartered in Issaquah, Washington, which is near Seattle, and it was founded in 1976. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Vienna, EuroTLX, Swiss, Santiago, Sao Paulo, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 252 billion market cap. They're trading at $5.67 a share, and they have 443 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have lots of free cash flow, and it nearly doubled from 2018 to 2019. It's $5.8 billion in 2021, which is still a ton of free cash flow. Free cash flow is the cash that's remaining after paying all your expenses. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows every year from 3.7 billion to 5.2 billion. Revenue is the sales for the company, and that grows a lot from 150 billion to over 200 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was the highest in trailing 12 months at 26 billion. Below that is operating expenses, and these are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, which was the highest in the trailing 12 months at close to 7 billion. Below that is the interest they pay in their debt, and that was close to 100 million. Below that is other income and expenses. These are all the gains and losses not tied to the company's core operations. Below that is their pre-tax income, then their taxes, then their net income, which grows every year from 3.7 billion to 5.2 billion. This is the company's income statement from their latest 10Q. This shows us the 3 months ending 11/22/20 and the 3 months ending 11/21/21. Their revenue grew from 43 billion to 50 billion. Their revenue from the sale of products went from 42 billion to 49 billion. And membership fees went from 861 million to 946 million. The company did mention they're going to raise membership fees this year, so that should help their revenue. In the past, when they raised their membership fees, they noticed the stock price has gone up. Here's their latest quarterly revenue by location: 36 billion in the US, 7 billion in Canada, and 7 billion outside the US and Canada. Here's their revenue by product: 19.5 billion by foods and sundries, 14 billion by non-foods. Examples of this I've seen at Costco are clothing, paper, soap. 6.4 billion of fresh foods. Examples are those rotisserie chickens and also fresh fruit. And over 9 billion of ancillary and other businesses. Examples are the sale of tires and also gasoline. So sales went up in every single category. So they continue to grow, whether during COVID or not during COVID. They're always growing. Their main expense is the cost of the merchandise, the stuff they sell to us. That's $44 billion. Also selling, general, and administrative expenses. Example is the payroll for its employees, also the rent at its locations. So they have pretty slim margins. Their operating income is $1.7 billion. All companies in this industry like Walmart, Target, Dollar General, all have really low margins. That's just the nature of the business. For instance, a traditional supermarket may have margins of 1%. Below that is the interest they pay in their debt, which was $39 million, the same as last year. The interest they receive on their investments is more than the interest they pay in their debt, $42 million. So their net income went up from $1.2 billion to $1.35 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. Yahoo Finance did not update the trailing 12-month numbers. They just have 19, 20, and 21. But you can see they generate lots of operating cash flow, almost $9 billion in 2021. When they buy a warehouse and buy equipment for that warehouse, all that is capital expenditures. And they spend $3 to $3.5 billion of CapEx each year. Those assets are put onto the company's balance sheet and depreciated over time onto its income statement. Operating cash flow minus CapEx gives you your free cash flow. And they have lots of free cash flow. It goes from $3.4 billion up to over $6 billion. It was $5.4 billion in 2021, and it's $5.8 billion in the trailing 12 months. I had to manually calculate it so I could put it into my Excel file. And they do pay a dividend with their free cash flow, but another way to reward shareholders is to buy back stock. And they do buy back a little stock each year, $247 million in 2019, $200 million, then $500 million. When a company buys back stock, it decreases the shares outstanding and makes your shares more valuable. They do add a little debt each year. They added $200 million in 2019, $800 million in 2020, and about $130 million in 2021. Adding debt is a cheap way to fund growth. You don't want to add too much debt because you have to pay the interest on your debt, and that detracts from the cash flows that would flow to the bottom line. Even worse is if you're not able to afford the interest payments on your debt, then you're forced into bankruptcy. But I do not see Costco ever running into that problem. This is their operating cash flow section from their latest 10Q. The 3 months ending 11/22/20 and the 3 months ending 11/21/21. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with $1.3 billion of net income. We add back $432 million of depreciation and amortization. We add back stock-based compensation. We have to adjust for changes in working capital. They spent $2.8 billion of inventory. That's a cash outflow. But when they sell that inventory, that'll be a cash inflow. They bought $3.4 billion of product on credit. That's a cash inflow. But when they pay for those items, that'll be a cash outflow. They had an accounting gain of $1.3 billion, but they actually generated nearly $3.3 billion of cash flow. Last year was accounting gain of $1.2 billion and generated $2.6 billion of cash flow. This is their cash flow from investing and cash flow from financing sections. In cash flow from investing, we start with purchase of short-term investments. That was $258 million. Then maturities of short-term investments, $444 million. Companies generally purchase short-term investments so they earn a little interest on the cash that they have in the bank. They spent over $1 billion on property and equipment. Property and equipment is part of CapEx. Their primary CapEx are land, buildings, and equipment for new warehouses. Also, they need money for manufacturing, distribution, and working capital. They just completed their first quarter of 2022. Even though the quarter ended in year 2021, it's their first quarter for the accounting year 2022. They plan to spend $4 billion in CapEx in all of 2022. They opened 9 warehouses and they relocated 1 in the first quarter of 2022. And for the next 3 quarters of 2022, they plan to open 20 to 23 new warehouses and relocate for. In their investing section, they had a cash outflow of $900 million. Last year was a cash outflow of $700 million. In their financing section, they had to pay $355 million of taxes. When a company gives stock to its employees, it has to pay taxes on that stock. It paid dividends of $350 million. It repurchased $37 million of stock. So in their financing section, they had a cash outflow of $800 million. Last year was a cash outflow of $700 million. Let's look at the equity section on their balance sheet. They have $18.5 billion of equity. They raised $7 billion from selling their business, and they profited $12 billion from running their business. Accumulated other comprehensive loss are unrealized losses, so they may realize losses of $1.2 billion in the future. Let's look at the capital structure. $18 billion of equity, $10 billion of debt. They're 65% equity, 35% debt. Even though they have $10 billion of debt, they could pay off all the debt with the cash on their balance sheet and still have over $3 billion of cash left over. So in a sense, they're debt free. And I gave them the whack on Simply Wall Street, 5.46%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year for, that's $252 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $222 billion. We divide that by 443 million shares. And we get a calculated stock price of $500. They're trading at $568, so they're trading at a 14% premium. It's a sell according to the model. I did a video on Costco last December when they were trading at $365, and my valuation was also pretty close to $500. And they beat my valuation. They're above $500. But Costco is one of those stocks that's pretty much going to go up over time. I would rather buy Costco when I say they're overvalued than a penny stock that I say is undervalued. Their annual revenue is projected to increase 7.5%. I increased their revenue 7.5% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers, and that comes out to 3%. So I multiplied their future revenue estimates by 3%. That's how I got their future free cash flows. Simply Wall Street's a lot higher than me. They're at $7.25 a share. They're saying it's 22% undervalued. 23 analysts priced this stock and the average price target was $560. They have a low beta, 0.63, so the stock is not too volatile. It went up 49% in the past 52 weeks while the S&P went up 29%. The 52-week low was 307, the high was 571, and the stock is trading above its 50-day and 200-day moving average. Over 2 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 69% are held by institutions, and only 1% of the shares are shorted. They raised their dividend from 50 cents up to 79 cents. They pay a 0.56% dividend yield, and it looks like they paid a special dividend of $10. When a company has excess free cash flow, sometimes they pay a special dividend. Most companies never pay a special dividend, and it's very rare for a company to pay more than one special dividend. They pay out 27% of their net income and 24% of their free cash flow, so they can easily afford the dividend payment. Their employee count has went up a lot the past year, so they must have added a lot of warehouses. They employ close to 300,000 people. If you invested $10,000 into this company 10 years ago, you'd have $89,000 today. That's a 784% return. Every quarter for the past 12 months, there's been insider selling. There's been very little insider buying, only 925 shares. Since the stock price is getting so high, I guess a lot of insiders are trying to cash in. That's why they're selling. Institutions own 69% of the stock and the general public 31%. The biggest shareholder is Vanguard at 8.5%, then BlackRock, State Street, Fidelity, and Capital Research. Let's look at their financial ratios. Their PE is a bit high at 48. PE is stock price over earnings per share. 48 means investors are paying $48 for $1 of earnings. The market median is 21. Their price of sales is pretty good at 1.2. That's stock price over sales per share. and their price to book is a bit high at 14, that's stock price over book value per share. Here's a list of their non-current assets on their balance sheet. They have $24 billion of property and equipment, $2.9 billion of operating lease right-of-use assets. This is probably an operating lease for some of its warehouses, and others $3.5 billion. They have an amazing return on invested capital of 37%. They can easily cover their interest payments more than 40 times. They have a great ROE at 28%. Their current ratio is a little above 1. Their quick ratio is well below 1 because quick ratio removes inventory from current assets. And as you can imagine, they have lots of inventory. Let's look at the current assets on their balance sheet. They have $13 billion of cash, $700 million of short-term investments, $1.9 billion of receivables. This is how much other companies owe Costco. And this is net of the receivables they expect not to receive, because a company rarely receives 100% of their receivables. They have $17 billion of inventory, so at any given time, they're gonna have lots of inventory. This is the inventory balance as of the end of November of 2021, which was the date of the most recent balance sheet, and other of $1.5 billion. Let's look at their current liabilities. They have $20 billion of accounts payable. This is how much Costco owes other companies. For example, they may buy cereal from Nabisco on credit, so they have 60 days to pay them. They owe their employees $4 billion. Accrued salaries is more of a timing thing. So when the accounting period ended, it could have been between a payroll period. $1.7 billion of accrued member rewards. I have $1,100 of that $1.7 billion because I accrued my rewards all year, and then in February they cut me a check. When they do cut me a check in February, they'll remove that $1,100 from their current liabilities and pass it on to the income statement as an expense. $2.2 billion of deferred membership fees. My annual Costco membership is $120. So they don't book the entire revenue when I pay my membership each year. They only book $10 a month onto the income statement. So every month they remove $10 from deferred membership fees from this section on the balance sheet and put it onto the income statement as revenue. $800 million of debt and $5 billion of other. They had nearly $6 billion of free cash flow in the trailing 12 months, $500 million of working capital. They paid out $1.4 billion of dividend payments. So it seems like they're well funded. They have nearly $5 billion of funding. So they should not need any debt or equity financing to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 9 companies in the same industry as Costco, and they have a low debt to equity ratio of 0.5, much better than the industry average. A bunch of companies in this industry do not pay a dividend. They do, but their dividend is lower than average, even if you include these zeros in the mix. They generate more free cash flow than the average company, but much less than Walmart, a little less than Target. They're the second biggest company on this list. Walmart is a lot bigger at $400 billion market cap. They're $250 million. All their price multiples are worse than average. Their price to book is a lot worse than average. Price to earnings is a lot worse than average. Big Lots has a really good price to earnings. Price to free cash flow is a little worse than average, and price to sales is a little worse than average. They generate a lot less revenue than Walmart, but double Target, and they're double the average. Their 5-year annual growth rate is much bigger than average. It's the second largest on this list. Ollie's is the largest. Return on assets is really good, better than average. ROE is really good, but it's worse than average. The average is really high in this industry. BJ's has a great ROE. So to summarize, I have them trading at a 14% premium, and Costco is one of my favorite stocks to own. I think it's a great long-term hold that should be in just about anyone's portfolio. It's a really well-run company, and they're always growing. Valuation isn't the entire part of my analysis, it's only one part, because no one can accurately predict the future. That's what valuation is, trying to predict the future. And I think there's so much more opportunity for them to grow outside the US, as well as inside the US. I ranked their free cash flows 8 out of 10, their revenue 9 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.